Hello, I'm Sunanda Jha from Lavan Investing, welcoming you to our weekly webinar. And before moving towards the topic of the day, we would like to wish you a happy and a prosperous Diwali. For today's topic, we have why Indian equities and some investment options on Fidelity India Fund and ETFs, along with one stock idea on HDFC Bank Limited. To talk more about the same, we have Vijay Raj, the portfolio manager of Lavan Investing, along with different investment manager who would share their insight on the same. So let's get started.
Hi, good afternoon. My name is Vijay Raj. I'm a financial planner and investment advisor with Lavan Capital. And it's a nice, beautiful day, Wednesday. Don't want to go to work. That's one of the bad things. But I wish work from home is better or not. That I don't know about that. But let's see how it goes. But at least feeling better at home, and wife is not happy. So that's one of the good thing or bad thing, I don't know. But yeah, I mean, she always, if I have a couple of drinks at home, she shouts at me. Anyway, let's go on to the macro themes, what's happening in the world. We just discussed like the last week and so a few things, and let's talk about some investment options, particularly into the emerging market. So in the emerging market, the world is changing, the global dynamics are changing. In that scenario, what's happening into the global GDP, global growth, where the growth is coming. So let's start moving with Indian macro themes, because as always, trend is my best friend. So what is the next trend coming up? Where are the emerging markets? So if you look around India, what are the scenarios? What are the macro factors that are playing role? Let's look into a couple of factors. First, I discussed this slide, I think 2 weeks back when we were talking about the global asset and those things. So we saw that 50% growth rate coming across in the Bombay Stock Exchange in the last year time frame. You can see that blue line just crossing up. As always, a couple of big factors, if you look at in a very short before you go to a couple of slides. So the first one is the biggest population. So I think, oh my God, Pooja, how much is the population? 1,250 million now, right?
Yes.
So very, very, very big population. So that's one of the things which we need to be looking around. So that's a big population. So much is a demand, young population, educated population. Look, with the education, I think the education standard and the professionalism is a little bit low. But I think, the another 3 to 4 years, I think with the young generation of the internet generation, things will be going to change, and we look forward to more professional people. And that will really, the youngest country, that will change the world in next 10, 20 years. Yep, that is one of the things. Again, if we talk about the macro political scenarios, now political is a little bit India-China drama is going on, India-Pakistan drama is going on, then you have an Afghanistan over there, and then you have Iran. So very, very volatile area. So that is a geopolitical scenario we need to be taking care. But I think now the world has a little bit, we don't expect that the world war type, I don't know, but that's my opinion, that at least human beings in the 21st century are a little bit better. So that's I may be wrong, but that's my opinion. If we talk in more detail into this one, another factor is a growth story, because the growth engine, so which are the driving the growth, with the driving the tailwinds and those things. So the demand coming up, disposable income, that is increasing across. So in last 20 years, I think India in the first 50 years of they had a very, they call Indian growth rate of 3%, 2%, 2 or less than 2%. The whole licensee Raj and those things. But after 1991 to 2000, the liberalizing the economy and a couple of sectors, that has driven the almost 9 to 10% growth on average for last 20 years. So that was absolutely great. Then this Modi government coming in, that had changed up the little bit scenario. I'll talk in more detail about that, please. Now, the consumption story. So what is the consumption story? So consumption story is such a big population, and that's consuming the whole thing. That's creating a very, very, very big demand into the whole market. And by 2028, that will be going to increase 3 times, so 330 trillion rupee in the rupee terms. So that's a big demand that will drive a lot of big companies to become a bigger sectors, particularly the couple of best sectors. If you talk about the pharmaceutical, banking, automobiles, that will be, I mean, massive scale growth in next 10 years that we will see. And you can see on the retail market, so many people standing in anywhere. Please forward. Uh, Again, the rising savings, which is one of the important factor, because the stock market, what drives the market is the interest of the people, the money flowing in the market. The money flowing in the market, lot of IPO companies coming in. In that IPO, those big companies then grow further on. So this is a very, very important thing to be having the fundamental basis. So the saving is a very important thing into the whole economic system. For moving forward, if you see for any market, the interest of the shareholders or the interest of the exchange board and creating that confidence in the population, that has changes the world. And India is fairly doing good and changing up. So like US market is the biggest market, but then 55% of US population is a retail investor. In China, the retail investor is almost 12%. In India, it's very, very less, 3. So there is a long growth. So you think of out of those 1,250 million people, if those people come in, 50% of that come in seek at the market would be unbelievable. So that we need to be. Pooja, what do you think? Am I making sense?
Yes, absolutely, Vijay, because this chart shows that how individual retail investors in Indian equities markets have been of total population, the percentage is 3.7. So that's absolutely true. Moving to the next slide, where we see the growth potential, India could follow China. So in terms of retail investor participation, China is probably a model of what you can expect will happen in India. So India could be easily equal China's market cap in the next 5 to 10 years, because going forward, growth in India's market will probably be faster. And China, because of its size, will probably grow more slowly. Yep. So yes, and now we have the
this one is like this is a very good estimate. So in 2016 and just in last 1 year or 2 years, 10 million new accounts have been opened. So I think half of Australia, I mean, opening up a new stock market investment account. So that's a big jump, very, very big jump. So that is a retail investors' interest showing up. Yeah.
Absolutely. So in this chart, we can see the active retail investor accounts rose by a record of 10.4 million in 2020. So according to the data from the country's 2 main depositories, raising hopes for growth in Indian equities as the nation is second most populous country in the world. Yeah. So can we have the next slide? Yeah. So
this one is Pooja. So if you look, still the whole $100 as a you consider, then still a lot of money is in gold and the bank deposit. So even if 3, 4, 5% comes in here in next year, that is also massive growth of the system will come in.
Absolutely.
Yeah, so that's a good sign of market booming. And as we talked about 48% return coming in last. So I think there will be double-digit growth for next couple of years. So that what happens, same with the Chinese alpha shares and those things. Please.
Absolutely. So this chart illustrates how India's citizens' wealth is currently positioned by asset type, heavily skewed to property, gold, and bank deposits, while equities with only 4% of allocation. We see there is a mix changing in favor of equities here. So moving forward, the rising liquidity, improving image of equities. Regulation is also improving in favor of the smooth functioning of the Indian equities market. So in 2017, SEBI created a warning system called the graded surveillance measure to prevent unwarranted price swings and manipulation of stocks with a market capitalization below 250 million rupees. So that's where SEBI has focused on safeguarding the interest of retail investors with measures such as raising financial literacy, improving transparency, and increasing regulatory requirements for the brokers. Yeah,
Yeah,
moving
look,
forward.
I think you're absolutely right. I think they brought some changes. I was reading some article and that the brokers, they got more scrutinizing of the brokers, and simultaneously, like I think in past, like Satyam scam and those kinds of things happen. So now they are much more stringent, and I think they are. I think I would use this word that Indian markets and a lot of other markets are getting together in the world scale, and they try to, because a lot of countries, like it's a global globalization of the financial system that's happening now. So in that scenarios, every country is interested that their money is safeguarded. So that's why the lot of exchange of informations and technology and those things happening. So that will make a big impact as well from the regulatory perspective. Yep.
Yeah. So coming to India's stock markets, which is BSE and NSE, let's now take a look at the two major stock exchanges. So BSE, since 1875, it has more than 5,000 listed companies, and these 500 companies have 90% market cap. So the total market cap is $2.3 trillion, whereas in NSE we have since 1994, and the listed companies is 1,800. So these are the two major stock exchanges in India. Moving forward, we have Sensex and Nifty 50. We can see here how the benchmark indices at the two exchanges have performed over the last 5 years. There was steady growth in the indices heading into the pandemic sell-off, and post the sell-off, the growth in prices has been steep. So there is a rise if you see in this chart in Sensex and Nifty 50. So yeah, this chart gives you more look into the largest market cap stocks in the Sensex index and how much total returns they have delivered over the past 5 years. Technology, finance, and consumer stocks have been running very well. Fossil fuel-based energy companies have been struggling. So that's how the Sensex has been performed since last 5 years.
Yeah, I think this the bank, the Hindustan Unilever, that's a Unilever of that's a global company as well. I mean, almost the Unilever in Hindustan Unilever, that's called, it's almost double in. So that's a massive, and the Reliance as well, and the Nation Paints is one to. If you get that Bajaj 400%, my goodness, I would be into that company. Oh, the Tech Mahindra, which we talk about, that's a Satyam. You know, that's what we talk, that the Satyam was taken over by Mahindra people. And I think they are getting right into the IT industry now. So that's a massive growth as well. Yep, Pooja, thank you.
Absolutely. Can we have the next slide, please? Yeah, so the stocks are driven by brand value and strength. The Tata Group of companies here was the most valuable brand in India with a value of more than 21 billion US dollars in 2021. So brand value versus brand strengths. While brand value is an important indicator for a company, the brand strength index is a crucial driver of the brand value. So that's where we can see in the chart about the brands and the strength and the profit they have earned.
Yeah, Pooja, I think couple of brands, these are world brands. I think Tata, I mean, 60% of the income that Tata is generating, that is coming from overseas, not in India. So those kinds of big multinationals are coming up. So we need to be looking at Indian banks, and those things are now slowly growing up. And yep, and a lot of even the major banks, where public sector banks, their government is going to privatize and making it more efficient. So that is a lot of good signs on the economy coming up.
Absolutely.
Please.
So moving forward, we can see this pie diagram which sector have built up much of the nation's corporate brand values. Of course, what we had discussed in the previous slide. Investor may consider positioning their portfolios in line with these brand weightings. In 2021, the share of brand value of conglomerates in India was 26%, while banking sector companies came second with a share of 16.3%. Incidentally, the insurance sector had the lowest share in the brand value, as we see in the pie across the country. So this is the pie diagram which represents the corporate brands. Next slide. Yeah, big is better in India. So brand values are developed with heavy investments and usually take time. In India, big, well-connected businesses win more often than lose. They are akin to smart capital. So that's where if we see these
Yeah.
conglomerates, they follow the family traditions like
Yeah, Pooja,
Tatas
I
and
think Pooja, I think if you look around those big pictures, I think that's the world's richest man. Reliance, Mukesh Ambani,
Ambani.
Anil Ambani, they are the I think, biggest, richest people, and Reliance Enterprises, I think Geo and those, they're doing massive into that. And the second big picture is Ratan Tata, I think the head of the Tata Group, chairman of the Tata Group. And then you have Anand Mahindra, the Mahindra Group of companies, and the Bajaj guy, the owning of the Bajaj Finserv and Bajaj Auto and those things. Yes, and now it's massive. They grew the company really very good in last 30 years. Very excellent. I think some of the leadership, I mean, in any business or anywhere, the leadership culture and those things are very important. So I think the system is having the top level head office, and then the culture going across the board. So I think, I mean, I've been when I was in India and I think those companies, they had a real great culture. I mean, fantastic.
That's true.
Yep.
Because it's one of tried and tested strategy that works in India, which we have seen noticeable presence of conglomerates in the Sensex, and their positive returns are just impressive.
So I
So
think
next,
we agree with that. I think this one is one of this bank's privatization. I think I think that is a long due. I think they should have done uh, way back in 2005 or 7. But I think due to political pressures and those things are not happening. And I think once upon a time in 2013-14, the non-performing asset was approximately officially, they were saying around 15%. Now, for a bank, because bank is the main liquidity, monetary policies and banking are the main engine. Now, in that scenario, a bank is having a 15% non-performing asset. I think then they came up with some regulation that a bank has to give out the real figures of non-performing asset, that if somebody or a customer haven't paid the money for next 3 months, the areas and those things, then putting the non-performing assets. So particularly this happened into a lot of big conglomerates as well, big companies as well, not on a lower scale, but on a higher scale. The big companies, they did failed onto that one. So that was one of the, I think, a lot of political scandals happened into that non-performing. But I think they are getting some good regulations, and they are making some good structural changes into the sector. So there are a lot of good news, and I think the government is consolidating these banks as well, merging of those banks and creating 2 or 3 big banks. I think that's what's happening. But again, look, India is a big country, a lot of people, democracy, very crowded scenario, and so it's a very difficult job as well, not that easy. Not like China, you order something and next day you got the things done. In India, you order something and then you get all the people on the road, guy, we cannot do it. So that's a challenge with that. I don't know, but that's what banks privatization is. But if it has its due now, please. So yeah, it will happen. Now we talk about some of the investment ideas. I think what are the investment ideas that's coming up? So Max, you were talking about, I think we had a discussion last week, and you talked about a couple of funds, basically. So yeah. I'll give to you, talking about both the how to invest in India. So I think with Indian investing, we have our brokerage arm as well. Which we're going to use it as well, but that's a very little bit complex. But from the Australian terms, we got direct. I think I'll leave it up to you, please.
Thank you. Thanks, Vijay. Yeah, we've been getting a number of inquiries actually in regards to gaining exposure, direct exposure to stocks in India. So it'd be good if where we can sort of over time, get that access through Laverne Investing, which would be very, very handy. We're getting a lot of interest. But but for now, people have got opportunity to invest in India indirectly through managed funds, active funds, ETFs. There's an ETF which I'll talk about, and also depository receipts of certain Indian companies that are listed on NASDAQ and New York Stock Exchange. It's not a vast list. There's only about 13 stocks with their ADRs listed in the US, and we'll talk about one particular stock as well. So to start off with the Fidelity India Fund, we know these guys. We've met with the team on a number of occasions as part of our research on this fund. It's India-focused fund. They've got about a bit over $200 million that they invest. They've been around for 15 odd years, 16 years, focused on India. They charge around 1.2%. They are a long-term, mid to long-term focused fund. So their returns on a shorter term basis from, on a 1 year or 3 year basis are not that exciting, but they start to sort of break away after 5 years. They sort of generate decent alpha. They've got a team of research analysts, Fidelity in India. They've got PM sitting in Singapore. And Fidelity as a brand has been around since for the past 60 years or so. So it's a global asset management brand. So quite interesting from that point of view, from resourcing as well. So if you wanted to gain exposure to India with some smarts about your investment strategy, well, this would be one fund to go through. If I could move on to the next slide, please. I talked about the performance. The fund itself has got a mandate of, past performance is never a definite indicator of future returns. We have looked into the process and the investment team of Fidelity Fund. It's all logical, it's coherent. They are very much bottom-up driven research analysts. They get into the industry sectors, they go into the companies and analyzing them. We like their exposure to, as Vijay and Pooja were talking about the thematics, a couple of thematics around conglomerates. Where this smart capital is in the Indian market, the thematic of the deregulation of the bank. So from that perspective, these guys are positioned in these two sort of exposures. So well-resourced team and solid investment process, but you'll have to be in there for over half a decade to start seeing some returns. That's one opportunity. The other way to play the Indian market is through the next two opportunities will be this ETF and a bank we'll talk about. Both of these opportunities we've got in our own portfolio. So we use this ETF, which focuses on replicating Nifty 50 index on the NSE, and that's a pure beta play on the Indian market. And I've obviously talked about the active fund Fidelity that's underperformed on a shorter term basis, does produce alpha on the longer term basis. But if you look at the returns of this ETF, it's generating 1 year returns of 56%, which is pretty much in line with what the market has been doing there. 3 year, 5 year returns are very good. So it's a decent play to play the market on a beta level. You will get the volatility along the way. The market has obviously run pretty hard in India, as Vijay was showing the returns. So if they come off, this will come off on a shorter term basis, but longer term, it's still a growth market. India is, and it's one way to play it. The MER is a bit above normal ETFs, about 69 basis points, but again, it will give you exposure to growth segments of the Indian market, i.e. financials, and the conglomerates and IT stocks. That's where, and the consumer stocks. That's where the growth story in India is, and it plays well into the large cap stocks. The big is better thematic that we talked about. That's pretty much 99% of the exposure in this fund. So that's another way would
Max, apart from this ETF and Australian market, do we have any other ETFs?
Oh, look, there are issuers of ETFs all the time. This particular ETF manager we've met, and we know them quite well. But if you wanted to play specific ETFs, thematic based, sector specific, yes, there are. We'll happy to take that and discussion offline. We can show you the names. But I think right now, we've been given our bent towards financial and the large caps, and the conglomerates and the diversified exposure. I think this gives us pretty much ticks all of the.
I think it makes sense. I think the big companies overall have done quite well as compared to the overall markets across the world. So because they were the first people to be coming across and driving up the economy. So I agree with you. So I think instead of going into the smaller sectors, I think this is better. Anyway, coming back to Max, thank you. Sorry, you're saying something, Max?
I was just going to say, Vijay, Pooja showed the breakdown of the two indices, Bombay Stock Exchange and the NSE. And you can see that Bombay Stock Exchange, whilst it's got 3,500 stocks listed on it, but really 500 stocks where is the market cap is. And that just shows you that there's long tail of small businesses with very small market caps that are going nowhere. So you want to remain at the larger end of town and not get too cute about gaining, specific exposure to up and coming stocks. But there's going to be new stocks coming. India's got a very good, you would know all people, there's a good incubation of high tech companies that in the last 5-6 years that have been incubated in the private market, and there's IPOs coming, on the market in this year and the years forward that will create opportunity to go beyond the large cap stocks. But I think for now, remain tight, focused at the big end of town.
Yep, I think I absolutely agree. Like basically, I think the Paytm and the Zomatos and those IPOs are like and incubation is fantastic. I think that is one of the areas which we should be looking across. Apart from this, I 100% agree. Now, thank you, Max. Now let's talk to Gaurav. Gaurav, you were talking about HDFC Bank. I think we had this discussion before as well, but let's take your opinion. What's happening? But 1,000% return in 5 years. My God, that's shocking. That's unbelievable. I think, and still you are betting on it. So I think I don't know, but 1,000% is too much. Hey, Max, Gaurav.
Yeah.
Please.
So we see long-term positive growth in the banking sector in India, driven by the positive demographic trends. The working population is increasing, the disposable income is increasing, plus the privatization, the regulatory environment, the privatization of the state-owned banks, which you also touched on, will see these private banks gain more share. But why HDFC? I mean, HDFC is the largest private bank in India. The stock price has done tremendously well after touching its lows in April 2020 when the pandemic struck. The bank has rebounded about 100%. I mean, though past performance can't be an indicator of future performance, but we do still see HDFC Bank as a steady, low risk and stable compounding story. Why? Net interest margin. So an important metric to value the banks is the net interest margin. The profit, the income the bank actually earns from its primary loans. So the bank has seen a trend from last 6 to 8 quarters where the net interest margin has been declining, but now the bank has reached an inflection point where management anticipates an improvement in net interest margin going forward, driven by growth in retail book outpacing the wholesale book growth. I mean, this could also be interpreted as an increasing operating expenditure given by incremental volume, sales, promotional activities, and other discretionary spending in the retail segment. However, in the long term, as technology investments are stepped up and the bank progresses on its digital strategy, operating leverage should come through. driven by a decline in cost of acquisition. The bank holds a very strong balance sheet with its strong capital position, with total capital adequacy ratio of about 20%, which is approximately 9% greater than the regulatory requirement, and ample liquidity with the last quarter's average LCR at about 123%, which is about $6 billion excess over the floor of 110%, which does position it pretty well to capitalize on the opportunities as the economy gets back on track, it recovers from the pandemic, and the economy gains momentum during the ongoing festive months. Another important point which we see as one of the big points is the bank is actually well prepared to tackle a potential third coronavirus wave. I mean, the bank has worked with its vendors, worked with the workforce, gotten it vaccinated, and does not expect to stop collections in case there is a potential third wave of virus. The bank is growing its commercial and rural businesses, gaining market share in all the segments. It's growing its retail segment, and we see the bank as delivering stable earnings and book value growth metrics with healthy asset quality performance, which has also seen a tremendous improvement compared to the COVID-19 times, with low stress across segments, though the bank is still over-provisioned for any potential restructurings. But we do see it as a positive, as once the economy starts to improve, these extra provisions could be released, leading to strong capital management initiatives.
Yep, Gaurav, thanks for giving that information, but just I'm concerned for one thing. Like with the deregulation of banking sector that happens, then those banks will become more stronger than compared to this bank, HDFC. So the global, after the market share and those, if you look at those figures, no doubts. But this was, I think, last 10 years was a good time, but in future may not be good time. Is that? I think Shruti asked me this question. She wrote it. Thank you, Shruti. But the question is very good.
The deregulation of the public sector banks is happening. So the government is these private banks, HDFC being a private bank, as the deregulation happens, as the privatization, as the government undertakes privatization, these private banks should see taking that market share from the public banks.
Yeah. And can I just adding to that, just Max here, it's actually a good tailwind, privatization of the unprofitable, the state government banks, because I see HDFC being the largest private bank participating in that deregulation and probably taking cherry picking some of the books along the way, so there could be an M&A opportunity. Traditionally, when the government has backed away from the market or banking market, that's actually been quite a driver for the private banks. So so I think on the whole, it's going to be quite a tailwind. It's actually favorable for HDFC as opposed to there's actually more competition right now. Because people are going through their political influences or crony capital, as you call it, to public banks and getting friendly deals where they should actually be going to a private operator, paying the right price for that is at the right level of risk that the bank would write it at. So the demand is growing, and it's going to go to more efficient private operators like HDFC. That's our thesis on it.
I'll just add one thing, Zach, here. And Vijay, you touched on something very important before, corporate culture. Why are those guys so successful? Those family, the culture they set. You're talking about a business that's been prioritized, that's used to being run by government, inefficiencies, that culture's not there, that go-getter culture's not there, the entrepreneurial flow is not there. Max touched on it. The risk management strategies are not there. You just write risk because it's your mate that's walked through. That takes decades to change. And that is something that you can't flip from a switch. So that's the other point. So, obviously the public banks coming into private sector are coming off a high base, but I think there's a lot of other inertias within a bank from a culture and corporate culture perspective, and the way the bank has done business for a long time, that's just not very easy to change. I think shouldn't be underestimated.
Yep, I agree with that. That's maybe the culture is the main driver, that how do you do business? That's the most important thing. And as the non-performing asset and crony capitalism that happened, so that will be a major. I think with HDFC, they are a very stringent bank. Yeah. They are controlling those NPS and those things in a very well manner.
Yeah, I mean,
I'll give good marks for that. That's one of the good things with this HDFC. They're very stringent norms.
Yeah. I mean, look at the profitability, Vijay. I mean, their net interest margin is around 4% or thereabouts. Australian banks operate well within the 2% net interest margin. Capital adequacy ratio is 20%, as Gaurav highlighted. Australian banks have got 12% or thereabouts. So better profitable business, better balance sheet, even compared to the best in the world, such as the Aussie banks. So, it's armed to play in the deregulated market.
Yep, no, it looks that way. No, guys, thank you very much. Thank you, Max. Thank you, Zach. Thank you. Chai, I didn't spoke anything to you. How are you doing? Any idea about Indian banks? Chai, you are a good analyst.
I totally.
You only know NAB, NA, and Z. That's it, and Commonwealth Bank. That's your word.
I just thought I'd let the smart people talk about the Indian banks today and stay out of it. But I totally can. I mean, there's a massive growth driver with a lot of the deregulation. You would have seen the Prime Minister come out and undertake that monetization process, and also, forcing a lot of the Indian population into opening up bank accounts. I think that's that cannot be that thematic from 2-3 years ago cannot be understated. The sheer fact that you're moving the economy from a predominantly a cash economy in the lower to the mid-income populace, and forcing them to open up bank accounts to do business and to do transactions, that is really fantastic for the country, and it's moving the populace to a more of a modernized state. And that's only to the benefit of these private banks. And I totally concur with my colleagues. I think with the incumbent state-owned banks, the problem with that often, and we see that across everywhere, not just in Australia. You always have an incumbent that's just fat and lazy and has benefited from the monopolistic position that they've been given previously, and they've moved to this privatization or this new world where they have to compete with the privately owned companies that have always stressed efficiencies. And I think there's a great opportunity for the bank that Gaurav spoke about. So that's my 2 cents.
Yeah, no, Chai, thank you very much. That was brilliant. And thank you very much all. I think, again, my name is Vijay Rajan. Thank you all, Pooja, and I'm from Lavan Investing. You can buzz me up all the time, and look forward to see you next Wednesday. But fantastic Indian markets, and Fidelity Fund and ETF securities of the ETF securities, and we talked about the HDFC Bank. So now, thank you very much, and see you next week. Thank you all. Thanks, Pooja. Thank you, Matthew.